All the major averages down 1% or greater. Joining us now is iCapital Anastasia Amoroso, a chief investment strategist, and Vital Knowledge, Adam Crisafulli. Plus, Leslie Picker is here with us to, well, talk about the banks. But Adam, first, let's start with you. We saw Treasuries bid. We saw the JOLTS report this morning. We saw this major pain in regional banks as we saw the sell-off there. Why? Why the sell-off?
So it's a little confusing in terms of bank stocks. I think this sell-off today was different than what you saw back in March. I think the March sell-off was driven by worries about an acute fear of deposit run. I don't really think that was the nature of the sell-off now. I think the focus is more shifting towards the secular outlook for a lot of these companies, the earnings power of the franchises. If you kind of go back to the Q1 earnings, which all of them have just reported, they kind of put to rest a lot of, again, those really acute deposit flow fears. Now the question is, net interest income, net interest margins are at a peak. Provisions have more upside than downside risk. Funding costs continue to rise. Deposit betas continue to move higher. The regulatory environment is going to grow more stringent for a lot of these companies in the wake of what happened with Silicon Valley and First Republic. And so it struck me as a different type of a sell-off, one driven more by the long-term earnings power of the franchise versus an acute deposit run, which was more the March story.
Anastasia, when you look at what the banks are doing, and then we've got a Fed meeting tomorrow, how much does that setup matter? Because everybody still expects the quarter point, but it's the color after that that particularly matters. And if stuff is breaking at least in the stock market, if not in the fundamentals, how much does that factor in?
Yeah, well, I think the sell-off today is a bit of a message to the Fed to say, look, there's not an acute crisis per se that's still ongoing in the banking sector, but there's still pain throughout the sector. And the reason why I think the bank action should really matter to the Fed is because, remember, in the last FOMC meeting, Fed Chair Powell really gave us new metrics to watch in terms of whether they're going to be raising rates or not, and that is the extent of the credit tightening that's happening in the economy. Well, John, if you look at the charts, I mean, they kind of really catch your attention because even though the massive deposit outflows from small banks have stalled out, which is good news, look at the credit flow. If you look at the net credit flow over the last 4 weeks, it is absolutely collapsed coming out of the small banks. It is also retrenched coming out of the large banks. So I think the Fed has to look at the price action that we saw today. They have to look at the credit charts and say, look, we've tightened rates enough. Maybe it's another 25 basis points. But after that, just let this Fed tightening kind of hand it off to the credit tightening because it is playing out and is in full swing right now.